Hello and welcome to another fact-filled edition of Bloke in the Pub. This week actually we're in a slightly different pub, you can tell from the background, and if you can see just behind me is one of my favourite wartime films called Where There's a Will, and one of the lead actors in that, a guy called Larry Hardcastle, who's the greatest life insurance salesman who ever lived, is why I actually came into financial services. So again, very different memories but very happy memories again this week. Tom's away, who you've seen in the other videos, but today I'm joined by Pete, who's not actually a direct investor with Higgs Boson at the moment. Obviously that will change, but you do have a bank account, and I know you had a question about your bank account.
So the Bank of England did something really weird with interest rates last week. What's all that about?
So what the Bank of England have done is they've decided they're going to lower interest rates. Lots of reasons for it. The principal one is there's a thing called the Purchasing Managers Index, which sounds as exciting as it sounds. And it's an indication of growth in the economy. And they've been watching that, lots of different indicators in manufacturing and service, and it looks as if everything is starting to slip a little bit over the last month or so. And the big worry with the Leave vote was that we'd go into recession as an economy. So what the Bank of England done, they've reduced interest rates. What they're also going to do is they're going to start something again called quantitative easing, which is pumping money out into the economy. So twofold. One is you're less likely to leave money in the bank and go and spend it if the interest rate and the return you get from a bank is lower. The second thing is that by pumping more money out into the economy, banks are more likely to lend to you and I and to businesses to make them successful.
Wow. So what does that actually mean for my bank account?
Okay, well, there's a couple of points about a bank account anyway. The first one is, what is a bank account for? And a bank account is where you just leave money for instant access. You're never going to grow money in a bank account. The reason banks have accounts like that is so that they can take your money and go and do something else with it. So I'm sure you've got a credit card.
Uh-huh.
Okay, and when you use your credit card, you probably pay some disgusting rate of interest on it.
Absolutely fine.
Right, it has to be, I think it's just under 29% to be not to be a loan shark, something like that. So the bank is making that money on everything that you spend on your credit card.
Gosh.
So how much interest does your bank give you on your bank account?
Not much.
Okay, so they're pocketing most of the money that they charge as interest on credit cards, loaning out your money.
Well, that's terrible.
So what this tells you straight away is you shouldn't be leaving a lot of money in the bank anyway. You shouldn't be expecting to grow. It's just to leave it for access. What the latest change means is that there's even less value in leaving money in the bank. So the Bank of England interest rate has dropped to 0.25%. So you're going to get virtually nothing by leaving money in the bank. As prices go up as well, your money is going to be worth less and less as time goes on. So it just means that there's less value of leaving your money in a bank account.
So what should I be doing with my money?
Okay, really good question as well. So where does this all go? What's being talked about at the moment is something called negative interest rates. All that means is you're going to be getting even less. In fact, the bank is going to start charging you to leave money in the bank. So not only are they going to be charging you huge rates of interest on your credit card and any loans, you're going to have to pay for the privilege to leave your money in the bank. The whole idea of that is that you'll take your money out and go and spend it and use it in the economy rather than leave it in the bank.
Right.
That's the first thing. The next thing is, where can you get any kind of return to keep up with prices as they go up? And really the only game left in town is stocks and shares. And the whole thrust of what the Bank of England is doing is to push money out into the economy to benefit companies so that they will continue to grow, and that's likely to increase their earnings and therefore increase their share price. So hopefully it pushes up the stock market. And if you looked at the stock markets at the end of last week, they really liked what the Bank of England had done and they've gone up as a result.
Great.
There you are. Nice, short, sweet one. That's it. So don't leave money in the bank. It's going to be worth less and less and less. Negative interest rates are simply that the bank's going to charge you to leave your money there. As prices go up though, you're going to be left behind. So you should be investing your money, asset-backed investments, and particularly stocks and shares.
Thank you.